and welcome to Doing Business As, the small business law podcast from Tracktown Law. My name is Jared Hight, and I am the founder of Tracktown Law and your host for today's episode. At Tracktown Law, I help Oregon and Idaho business owners understand what actually matters when it comes to legal structure, taxes, and protecting what you're building. Today, we're answering one of the most common questions. How do you actually pay yourself from your LLC? This comes up constantly with new business owners, especially in the first year or two. You've formed an LLC, maybe even opened a business bank account. Great. But now you're staring at that account balance and wondering, how do I get paid? Can I just transfer money to myself? Do I write myself a check? What's legal? What's smart? Let's break that down. But first, a quick reminder that while I'm a licensed attorney in Oregon and Idaho, listening to this podcast doesn't make me your lawyer, and nothing here should be considered legal advice for your specific situation. That said, let's get into it. How you pay yourself depends on how your LLC is taxed, and that, in turn, depends on how many members your LLC has and whether you've made any special tax elections. By default, if you're the sole owner of an LLC, the IRS treats you as a disregarded entity. That means for tax purposes, they don't see your LLC as separate from you. The business income flows straight to your personal return. You're not considered an employee of the business, and you don't take a salary. Instead, you take what's called an owner's draw. You're just pulling money out of your own business's profits. There's no payroll involved. You don't withhold taxes. You just transfer money from your business account to your personal one. That's your income. You report it on Schedule C of your federal tax return, and you pay self-employment tax on the net profits. Now, if your LLC has more than one member and you have an elected S-Corp status, then by default, the IRS treats your LLC as a partnership. In that case, things get a little more complicated. You still don't take a salary. Instead, the LLC files a partnership return, Form 1065, and issues a K-1 to each member showing their share of the profits or losses. You're typically still taking draws from the business, but those draws aren't income in and of themselves. Your income is based on your ownership share of the profits, not how much money you actually take out. You might also get what's called a guaranteed payment. That's a set amount paid to a member for their active services in the business. Think of it as the partnership version of a salary. Guaranteed payments are deductible to the LLC and taxable to the recipient, but they're subject to self-employment tax just like draws. Let's say you and a partner in Boise run a small creative agency through an LLC. You split ownership 50-50, each of you gets a $3,000 monthly guaranteed payment, and then you split any remaining profits based on your ownership percentage. That structure makes sense if you're both doing day-to-day work in the business and want consistent income, but still want to share profits as they come in. Now, if you've elected to have your LLC taxed as an S-Corp, which we covered in detail back in episode 6, then the rules change. In that case, you are required to run payroll and pay yourself a reasonable salary. You are an employee of your company. That means you withhold payroll taxes, file W-2s, and pay yourself through a payroll service. On top of that, you can take shareholder distributions, basically the profits of the business, without paying self-employment tax on that portion. That's where the potential tax savings come in. But don't get cute with it. The IRS expects you to pay yourself a reasonable salary first. If you try to pay yourself $10,000 a year and take $90,000 in distributions, you're inviting an audit. And just to be clear, salary is a payroll expense. It gets processed through your payroll provider, taxes are withheld, and the LLC pays the employer share of Social Security and Medicare. Distributions, on the other hand, are recorded as equity draws and don't go through payroll. That split between salary and distributions is what makes S-Corp taxation attractive for certain LLCs, especially once you're netting $80,000 or more in annual profit. But it does add complexity. You've got to keep clean books, run payroll, and file a corporate return. So that's the high-level overview. But let's talk about what this looks like in practice, especially for small LLCs in Oregon and Idaho. Let's say you're a freelance web developer in Eugene. You set up a single-member LLC, opened a business bank account, and started getting paid for projects. You're not taxed as an S-corporation. In that case, you can pay yourself anytime by transferring money from the business account to your personal one. That's your draw. You'll still owe self-employment tax on your net income, so make sure you're setting aside money for taxes. A good rule of thumb is 25% to 30% of your profits, depending on your tax bracket. Or maybe you're part of a husband and wife team running a coffee cart in Nampa. You file as a partnership. You can take periodic draws based on your profit-sharing arrangement. If one of you does more day-to-day work, you might include a guaranteed payment in your operating agreement to compensate that effort. Again, it's not payroll, but it is taxable income. Now here's where people get into trouble. They take money out of the business however and whenever they want. Sometimes it's a draw, sometimes it's for personal expenses, sometimes it's a loan to themselves or their cousin or whoever, and then come tax time, they have no idea what their income actually was, what the business earned, or whether they overpaid or underpaid themselves. That's not just sloppy, it's risky, especially if your LLC ever gets audited or sued. You need to show that the business is a separate entity with its own finances and that you're not just using the account like an ATM. So here are a few simple practices to keep you out of trouble. First, pay yourself on a regular schedule, even if it's informal, once a week, once a month, whatever works. It helps with budgeting and shows consistency. Second, only take money out if the business can afford it. Don't drain the account and leave yourself without money for taxes, bills, or upcoming expenses. Third, document everything. Whether you're writing yourself a check, transferring money electronically, or using a payroll provider, keep clean records. Label the transactions in your accounting software. Track draws, guaranteed payments, and distributions separately. Fourth, if you're taxed as an S-Corp, make sure you're following all payroll requirements. That includes filing quarterly tax returns, issuing W-2s, and setting a salary that the IRS would consider reasonable for your industry and role. And finally, if you're not sure whether your current pay method is appropriate, or if an S-Corp election might make sense for your business, talk to a professional. These are fixable issues, but they get harder to unwind the longer you wait. The bottom line is this: how you pay yourself is more than just a personal finance question. It's a legal and tax question. Done wrong, it can lead to IRS penalties, lost liability protection, or a giant accounting headache. Done right, it keeps your business clean, your taxes predictable, and your stress level way down. If you want to read more about this topic or refer someone else to it, the companion blog post is live now at tracktownlaw.com. It walks through everything we covered here, with a few extra notes on state-specific quirks in Oregon and Idaho. Next time, we're moving into hiring territory, specifically what to know before hiring your first employee. From legal compliance to tax setup to avoiding common first-time mistakes, Episode 11 will get you ready to grow. Thanks for listening.